As inflation edges closer to the Federal Reserve's 2% target, the conversation at hand revolves not only around achieving this goal but doing so without sending the labor market, and the broader economy, into a tailspin. At the most recent Wall Street Journal's TechLive conference in Laguna Beach, Mary Daly, president of the Federal Reserve Bank of San Francisco, made it clear that the Fed would likely continue cutting interest rates, emphasizing a cautious stance to prevent further deterioration in the labor market. But behind Daly's calm and collected tone lies an uncomfortable reality. At a time when the global economy is navigating stormy waters, the U.S. Federal Reserve faces a dilemma of epic proportions. Cut too much, and you risk an asset bubble. Cut too little, and you're choking off economic recovery. So, is the Fed's current strategy a calculated move towards long-term economic stability, or could it evolve into a policy misstep that sends shockwaves throughout the economy? Let's first look at the bigger picture. Since the onset of the pandemic, the U.S. economy has surprisingly bounced back quicker than many had anticipated, but this recovery has been uneven and fragile. Several indicators, such as job growth, wage increases, and overall consumer sentiment, paint a mixed picture. As Daly mentioned during her speech, one could argue that the labor market is already on a precarious footing. Hence, the Fed's rationale for trimming rates is to ensure that labor conditions do not weaken further. But job numbers, like most economic data, tell an incomplete story. Yes, economic data pointed out that hiring has been stronger than initially reported, but much of that growth comes from low-wage, part-time, or temporary jobs roles that are more disposable in times of financial stress. We've seen this pattern before in past recoveries, where initial headline numbers look encouraging, but beneath the surface lies an economy struggling with stagnant wage growth, underemployment, and precarious financial stability. The question on everyone's mind: why is the Fed cutting rates when inflation is already nearing the 2% target? The answer lies in the subtlety of monetary policy goals. Looking beyond solely maintaining inflation at a 2% target, the Fed is tasked with fostering stable employment and economic growth. While inflation targets give the illusion of stability, other mounting concerns such as deteriorating productivity, eroding business investments, and labor market volatility make this situation especially tricky. Cutting interest rates, often seen as a classic stimulant to spur borrowing, investment, and consumption, is the toolkit central banks default to when economic growth shows signs of slowing. At face value, the Consumer Price Index, CPI, is showing a deceleration toward the 2% target. This, in theory, gives the Fed the space to reevaluate and ease monetary tightening. But core inflation, which excludes the volatile components like food and energy, stubbornly remains above the comfort zone. Furthermore, inflation might be cooling on paper, but the average consumer has yet to feel significant relief. Food prices have soared 20% over the past 3 years, rent has escalated over 6% annually in key urban areas, and energy costs continue to seesaw depending on geopolitical tensions. Essentially, inflation metrics may look stable, but real-world price increases still affect consumer behavior. Complicating the matter even further is the global macroeconomic uncertainty due to sustained geopolitical risks. Think the ongoing Russia-Ukraine conflict or economic tremors from slowing Chinese manufacturing output, which continue to threaten supply chains. Global food and energy prices, already experiencing supply-side disruptions from regions like Eastern Europe, could make inflation control efforts feel short-lived. Now, let's tackle the issue of labor market tightness. The Fed, along with several other prominent voices in policy making, appears nervous about the idea of overheating the labor market. In theory, when unemployment falls too low, workers gain the upper hand, which leads to wage growth. And if wages increase too quickly, that cost gets baked into prices, leading to more inflation, a classical scenario of cost-push inflation. But dig deeper, and you realize that this isn't entirely the case. Despite the low headline unemployment numbers, real wage growth has been relatively flat. According to the Bureau of Labor Statistics, BLS, median weekly earnings for full-time workers only increased by 1.4% year-over-year in Q3 of 2023, after being adjusted for inflation. That's certainly underwhelming given the so-called tight labor market conditions. Why is this the case? One reason, simply put, is labor force participation rates remain below pre-pandemic levels. A large portion of the workforce either retreated permanently, early retirements, long-term illness, or opting out due to lack of childcare, or hasn't returned to full-time work due to mismatches in skills. Hence, a stable unemployment rate is masking larger problems: labor hoarding, employers holding on to workers at low productivity level fearing they can't rehire later, increased part-time hiring, and precarious gig economy-style employment. Thus, in reality, the labor market isn't tight in the conventional sense of the term. If wage growth remains measly, businesses have less pricing power because consumers aren't flush with cash, which would lead to slowing demand-side inflation. However, suppressing wage growth indefinitely can hurt long-term productivity, consumer spending, and ultimately lead to weak demand, giving the economy a stagflation-type feel without severe inflationary pressure. Now, let's zoom out. The ramifications of further rate cuts extend beyond American borders. In today's deeply interconnected world, every policy decision by the Fed ripples through international markets. A reduction in U.S. interest rates can significantly affect capital flows, especially towards emerging markets. Opting for an aggressive dovish stance can push investors to seek higher returns abroad, leaving emerging markets, which rely on foreign capital, in precarious positions. Historically, we've often seen that capital flight from higher-yielding economies can lead to financial instability, whether it's in Latin America or parts of Southeast Asia. The weakening of the US dollar due to prolonged easy monetary policies can also reduce the purchasing power of foreign economies that hold significant US debt and need strong dollars for trade. And at a time when China's economy has been cooling, any further volatility could wreck the delicate bounce-back some emerging or developing regions are hoping for. Meanwhile, US-based equity markets have typically rejoiced when liquidity conditions ease. But here too, caution is required. A consistent cycle of rate cuts risks inflating speculative bubbles, particularly in real estate and all things tech-related. Historically low interest rates during the past decade funneled capital into risky, often unprofitable ventures, think back to the startup IPO frenzy. A continuation of these policies risks exacerbating the trend. If the bubble were to pop, it could leave policymakers scrambling once again to prevent another major collapse akin to what we saw in 2008. There is also the problem of corporate debt. Given that rates have been so low during the prior decade, companies have loaded up on cheap debt. According to S&P Global Ratings, non-financial corporate debt has reached unprecedented levels, $10 trillion in the US alone. If interest rates rise again due to a potential Fed miscalculation, companies drowning in leverage could face a credit crunch, a dangerous scenario for employment and overall growth. The Federal Reserve's strategy for successfully balancing inflation management and labor market concerns requires more than just broad strokes. Data-driven decision-making is the mantra, but what data should the Fed be prioritizing? 1. Focus on core economic fundamentals. Rather than reacting to short-term data fluctuations, e.g., labor market tightness, the Fed should take a long-term view of underlying economic weaknesses. Wage stagnation, weak productivity growth, and consumer debt levels should play a larger role in the Fed's policy direction. 2. Avoid over-reliance on traditional economic models. Monetary policy effectiveness has clear limits. Quantitative easing and rate cuts may provide short-term relief, but structural problems tied to productivity and innovation stagnation, particularly in industries linked closely to exports, energy, and technology, need fiscal and policy interventions outside the Fed's remit. 3. Inflation targeting needs flexibility. The Fed's current mandate of strictly maintaining 2% inflation seems outdated. Given the era of overglobalization, rapid technological changes, and unique demographic trends, the Fed might consider targeting broader economic stability measures, such as constraining asset bubbles, steering productivity growth, or even fostering sustainable wage growth. As the Federal Reserve embarks on this next phase of easing, it's worth asking if they understand that financial stability, not inflation alone, should dominate the conversation. While maintaining inflation within a target range is critical, the quality of recovery will depend on a holistic view of the economy, one that balances worker welfare, actual wage growth, sustainable employment, and long-term sectoral health, particularly in industries such as tech that rely on global flows and innovation. By cutting rates amidst this delicate economic recovery, the Fed risks kicking the can down the road and allowing imbalances to build up, especially in areas such as corporate leverage and speculative bubbles in asset markets. The Fed is walking a tightrope, and one misstep could have broad consequences not just domestically, but globally.